All right, our global financial crisis has had a significant effect on individual investors, with the S&P 500 losing more than half of its value from its peak to the March lows. Many American investors lost a large portion of their retirement and their net worth. The question now, as the market recovers, will investors ever come back into the market after being burned so badly? Joining us for a roundtable discussion on investor psychology is Peter Boockvar, equity strategist at Miller Tabak. Also, Stephen Leeb, president at Leeb Capital. He's also the author of Game Over, and he has a PhD in psychology and mathematics, we should mention. George Walper is here, president of Spectrem Group, a research and consulting firm that specializes in the affluent and retirement markets. And, of course, Bloomberg Markets editor Andy Cinco is joining us for this as well. Peter, I want to start with you because I got this idea kind of from Miller Tabak. Are you getting the sense that some equity investors, and maybe not all of them, but some of them have been burned so badly, as you said to me this morning, once bitten, twice shy, that they're just never going to come back to equities?
Yes, I believe that, especially if you're older than 60. You experienced what happened in 2000 to 2002, and your nest egg just got cut in half again if you were exposed to equities. So I think fixed income is going to be the direction that a lot of these people take. I don't think the risk appetite is there. I don't think the perceived time horizon is there. And I think they'd rather clip coupons than roll the dice with equities.
Is this why we're seeing more fixed income buyers come into the auctions that we've seen? There's been somewhat of a surprise in demand, especially in the short end of the curve for treasuries. Is that part of what's happening here?
Part of it, but you also have many investors that are afraid of inflation and they want to be only in the shorter end. So if you're going to be in fixed income and you had a choice of what part of the yield curve you want to be exposed to, it's the short end. But at least from the baby boomer perspective, it's fixed income, whether it's corporates or high yields or even international bond funds. It's not equities.
Stephen, let me ask you, because of the psychology degree here. Do people really ever learn? Because it seems like a lot of people must have gotten burned a lot of times, and they still continue to come back.
I think it's different this time, Matthew, and I'll tell you why. What's been going on has been going on for the last decade. If you take a look at a chart, Bloomberg Terminal, for example, of gold and the stock market, the S&P 500, since the beginning of the decade, gold, which is a refuge, it's a measure of uncertainty, has gone up sixfold compared to the S&P 500. Gold's up about fourfold. The S&P 500 is down about 30%. That tells you that things have dramatically changed. Now, I think the icing on the cake was what we saw just recently. I mean, this was a major sea change. All of a sudden, the government owns iconic firms. All of a sudden, you know, you did have a historic stock market drop. You have to go back to the Depression to find anything like it. And no one has that kind of memory, or very, very few. If they do, they're very lucky to have their marbles. So there's been a change where I disagree a little bit. I don't think you can conclude people are necessarily going to gravitate toward bonds. I think they just as soon could gravitate toward inflation-leveraged investments like gold. That, to me, is at least as likely as bonds, probably more likely.
Let's, George, you actually did a survey here and found that almost all of the people that you talked to thought this was the most significant financial event of their lifetimes. Do you think that's because it's the most recent, or do you think it's really the biggest thing that they've lived through?
No, you're right. 90% of investors said this is the biggest financial event in their lifetime. All different ages, from baby boomers, younger, senior citizens. And I agree with you, significantly different than events that we saw after September 11th and into 2002. So we clearly are seeing that this is a significant change and will last for many years in terms of how people think about investing.
But how is that? What is the change there? Because, and I have not seen your survey, because what we were talking, Matt and I, before about is ETFs have grown exponentially, and they have changed your choices. If you thought China's great, and they're up 50% this year, you can get exposure to that. If you want oil, if you want silver, copper, you have much easier access to those markets. And I wonder if we framed the question incorrectly to say they're moving away from equities. Maybe they're just doing it in a different way.
Well, actually, we asked them how they were invested in December of this past December, and we compared that to research we did ourselves last April, so a year ago. Okay. And we say, where are you planning on investing? And they do intend to continue to invest in those types of assets, asset classes, and products, but they're saying to a lesser degree, far more into cautious investments. The contrary to all this, however, is the population of age group, call it below baby boomers, whatever, Generation X, whatever we'd like to call them. they're actually saying this is the time for them in their life because they think they have 20 years to invest in equities and to invest in real estate.
Although if you look back, we just showed a chart of equities over the last decade. You didn't do so hot if you were invested for the last 10 years. I think you mentioned, Peter, when we were talking this morning, from 64 to 81, you didn't really come away with many returns there either if you invested in equities. So the buy and hold strategy doesn't necessarily work for all these time periods.
Yeah, I think it's very interesting, the 64 to 81 period, because that is within the memory of baby boomers. And that was a time where you could have made an awful lot of money had you invested in inflation-leveraged assets like gold, like oil, like energy, commodities of all sorts. In fact, I mean, gold during that period, or at least during the 70s, its annualized, real annualized rate of return was something like 22 or 23% while the market was going down. So there were a lot of people that got rich in the 70s if they considered a third or fourth asset category. Now, when we look at the market or we look at how do we divide our investments, it's cash, bonds, or stocks. I think that by, a not too distant future, you also see a fourth category there. Precious metals inflation hedges.
Peter, it's almost like he's aiming these gold comments at you. I got to ask you what you think.
Listen, I've been a bull in commodities for a long time, and I agree. But we're assuming that the average baby boomer is going to say, oh, I should be in gold and I should be in corn and wheat. They're not thinking along those terms. And we're discussing whether they should be in equities, whether we've removed a generation of equity investors relative to the market. I agree commodities are going to be the place to be for a while. I believe in the reflation trade has legs. But we have to assume that the average baby boomer is not necessarily thinking along those terms as opposed to a sophisticated investor is.
I'm not really sure that's the case, because the average baby boomer lived through the 1970s and remembers going to the grocery store in 1980 and wondering what price he or she is going to have to pay for cat food because it was X cents, the day before and maybe, X plus 10 cents today. Those fears really don't die. And I think it won't take a whole lot for those fears to come back.
Oh, I agree. Anybody who asks me where they should put their money, I tell them hard assets. But not every baby boomer has access to a financial advisor to make that decision. They're going to be
and in the 70s, maybe I wouldn't say a lot of baby boomers had a lot of money to invest either, right? Didn't they just start investing?
They did see it. And let me just give you one factoid. It's happening in Europe. I mean, Europe's gone through the same mess that we have. Germany recently, I got this Bloomberg story. Germany recently instituted an ATM machine where you put in money and get out gold coins. I mean, that's sort of, what's happening, and it doesn't take a whole lot.
Those crazy Germans.
No, it doesn't take a whole lot for a financial planner to say, hey, look at this chart. S&P 500 down 30%, gold up 400%. Now, that's a 10-year chart, and we haven't even seen inflation yet.
All right, listen, we're going to take a quick... I know, George, you want to get in here. We're going to take a quick break. We'll be right back. More from George Walper, Stephen Leeb, Peter Boockvar, Andy Cinco, and myself. Stay with us. We're talking about baby boomers. Have they been too burned and they're never coming back? All right, we continue our roundtable discussion on retail investor psychology with Peter Boockvar, equity strategist at Miller Tabak, Stephen Leeb, president at Leeb Capital, George Walper, president of Spectrem Group, and Andy Cinco, our markets editor. And George, I want to get to you first because it's interesting. When we were setting up this roundtable, I was thinking it's going to be tough to get wealth managers to come on because they need, obviously, baby boomers, business buying equities. It wasn't tough, though, to book guests here. People, you say, are investing more and more without using professional wealth managers, without using stockbrokers.
Well, at a time right now where you would think that investors should use advisors, they're actually pulling away from them because they have lost confidence in what the advisors are telling them. So these wonderful investment ideas we're chatting about are really difficult to get on your own. You really have to get connected with a really good professional advisor or a financial planner. And yet, psychologically, they're saying, I'm going to do this on my own now. I'm going to continue to invest and go more cautious because I don't have confidence in what the advisor community told me the last 15 years.
Well, and wasn't part of that problem at the end of last year when every asset class went down? It didn't matter what you owned other than treasury bonds. Everything fell, and it didn't matter if a mutual fund manager was on style or off style. You got beaten up.
I don't want to beat a dead horse to death, but there was one asset class that went up last year, and that was gold.
Another interesting point is really the explosion of ETFs because they make it easier for, as you mentioned before, the individual investor to do his own investing or her own investing in sectors.
Within reason, Matt, within reason. And China is a good example because we've looked at this a couple of times. And yes, there are ETFs that track China, but in fact, the best one is a closed-end fund is what we've figured out. Even that's not a perfect one-to-one ratio with how China moves. So ETFs are a solution, but they're not a perfect solution, especially if you're going to pay fees and have roll costs with some of the commodity ones as well.
But it does, it really does change the game a little bit because, again, let's say Warren Buffett interviewed, and he says he loves Brazil. I don't know if he said loves, but he really likes Brazil. Yeah. And you can buy a Brazil ETF. Now, 10 years ago, the investor listening to a Buffett interview, hearing Brazil saying, oh, my goodness, that's for a guy that has $1 billion. But now it's for a guy that has $1,000. Which is a game changer.
Absolutely. There's been an explosion in ETFs. Actually, take a look at this. ETF shares outstanding. 2004, $4.5 billion. Now $14.2 billion. Total volume back then was 2.8 million. Now 24.3. Actually, I'm going to guess that's actually in billions as well. Number of ETFs, now they're 845. I'm sure there are a number of gold ones there for you, Stephen, as well, coming in up from 168. Let's talk about, just for a minute, though, get back to the fixed income idea, because we did a study looking at the average employee who's invested in his 401k in his 30s over the past 10 years. If he was in equities, he obviously lost 27%. If he had been invested all in bonds, he would be up 62%. What do you think about that sort of win at bonds over equities going forward? Is that going to continue?
Well, the pace of that outperformance may not, because many equities are inflation hedges. So we do get the type of scenario that I believe will happen. Along with Steve, you will have performance in certain equities. But we're also dealing with a segment of the population that needs fixed income. They're not working anymore. They rely on their 401k to finance their everyday needs. Gold doesn't provide an interest income to them. Corn doesn't provide interest income, but a 3-year GE bond does. So we have a growing segment of the population that will no longer be working, that relies on fixed income. And they don't want to be long a Brazilian ETF to provide them with that income. They're going to be in fixed income, and that's going to be part of the population that's not going to be in equities.
It's interesting. I want to actually finish with one more thing. We only have about a minute. I want to bring up an email from a viewer that we got asking really if this is all kind of too much inside baseball in equities. And George, let me ask you what you think about this. One of our viewers wrote in, John, he said, as an individual investor, I'm concerned that the SEC will just give us a head fake rather than reinstate the uptick rule, as well as aggressively enforce the naked shorting rule. Really, a lot of viewers have written in and said, I think this market's cheating us. The inside guys know a lot more than we do, and we just can't win here.
Well, there's great perception that what created a lot of these difficulties was Wall Street in general for the everyday investor of all different levels of wealth, and there is that big concern, for sure.
Unfortunately, that's all we have time for. These things are always too short, but thank you so much, Peter, Stephen, and George for joining us. Andy, thank you as well.